Sheldon. I work for KBI Global Investors in Dublin. It's becoming more clear by the day that the world is encountering greater problems tied to water, from scarcity affecting availability, to contamination in drinking water and the environment, to the dilapidated infrastructure leading to disruption and expensive emergency fixes. The World Economic Forum, in advance of their annual gathering in Davos, they put out a list of the top risks to the global economy. In 2010, none of them were tied to water. In 2017, 4 of the top 5 are tied to water. So it's an increasing problem. There are solutions, and it's just a matter of commitment to execute those solutions. And so what we do, what investing in water means, is companies providing solutions to those problems. We view that along 4 different categories. Companies that are increasing supply and access to water, such as desalination, or a utility that's building out connections on the outskirts of a city. Category 2 is companies that are decreasing the demand or reducing the waste of water, such as efficient irrigation, efficient plumbing, leak detection. Category 3 is companies that are treating the water and assuring the quality of water, so lots of different technologies for water treatment and test and measurement. And the 4th category are companies that are building and fixing the water infrastructure that already exists. So investing in water is looking for those types of companies that are publicly traded that we can invest in and benefit from the long-term tailwinds. Yeah, McKinsey did a study a few years back looking at different categories of infrastructure spending. Their forecast for spending on the water infrastructure from 2013 to 2030 was $12 trillion. What's interesting to me is that's about the same size as power and same size as telecom. And while most investors have plenty of exposure to power and telecom, very few have exposure to the water opportunity. We think we're at the front end of the next wave of investing in water. If you look back at the early 2000s, water spending was really driven by the developed market housing boom. After the great financial crisis, we saw wave 2, really driven by industrial water, whether it was the energy renaissance in the US, the Chinese stimulus, or global corporations really taking serious their responsibilities in addressing their energy and water footprints. Wave 3, as we've been calling it, is really driven by infrastructure and policy-led initiatives. The populism that we're seeing in politics around the world has hit the water space. People are demanding better quality water. They're not content with contamination. And politicians, whether they're elected or appointed, know that the way to maintain their leadership in the past was to maintain low cost of water. Today, it's to make sure they're not on the front page of the newspaper because they left problems unaddressed. So in order for a company to be investable, it needs to be a publicly listed stock. They tend to be small to mid-cap in size, and they have to be involved in the water industry. We categorize that based on purity in order to get into our universe. And once they're in our universe, we put them into 1 of 3 categories: water utilities, water infrastructure, and water technology. They all have different characteristics. Water utilities involve regulated monopolies or companies with long-term contracts for supply or for treatment. Water infrastructure, these are more cyclical type of companies, so pipes, pumps, and plumbing, hydrants, irrigation equipment. It would involve engineering and construction. And then in the middle is a water technology companies, so companies that have treatment technologies, smart metering, leak detection and infrastructure diagnostics, or chemicals. Once they're in our universe, they're investable. So we look for the best risk reward, and we really look at what is driving these companies' earnings growth over the future. Investing in water provides a unique diversifying element to a global portfolio. See, there really is no such thing as a water sector. It's a collection of lots of individual niches, and each of these niches deals with different parts of the global economy. So you have a very well diversified portfolio, but actually what you're getting is you're getting a representation of the global economy through the lens of water. We tend to fish where others aren't fishing, and so it provides unique stocks that are not held in traditional portfolios. And also, because they tend to be small and mid-cap in nature, many of them are under-researched and under-owned, so it provides an alpha opportunity for water-focused investors, which is the philosophy of KBIGI, our natural resource funds, because we spend all of our time focused within our particular strategies, me and water. It allows us to really focus and identify strong, under-researched, attractive investment opportunities. Just because a company's in the water industry doesn't mean it's a good stock. So we run a concentrated portfolio of what we see are our best ideas. So best ideas, on our definition, mean good upside to their risk-adjusted price targets. And so we want our better ideas to be our bigger positions, and so that's why we have a concentrated portfolio. KBI Global Investors started their water strategy at the end of the year 2000, so we have a 16-year track record at this point. Over those 16 years, we've outperformed the global markets by over 3 percentage points per year, and it's been fairly consistent. We've gone back and looked at why that might be the case, and it's a combination of consistent faster growing per share, faster earnings per share growth, as well as every year we tend to have 1, 2, or 3 companies that are acquired, which always tends to happen at a premium, so that benefits the strategy as well.